Okay. So good morning to everyone. So last time we started on mutual funds. We were talking about mutual funds, or what we call unit trust funds in Sri Lanka. And essentially, when we spoke about mutual funds, we said that these are funds that pool investments of multiple investors together, multiple investors that share a common goal, right? A common financial goal. And based on this, we said mutual funds is where you pool together multiple people's funds, and you have a trustee that looks after the interest of the investors, and you have a fund manager that will invest the money that is pooled, the pooled money, according to the objective of the fund. And whatever returns that the fund makes, essentially in the form of unrealized gains, realized gains, dividends, coupons, all of these returns belong to the investors, and they can get it back either through the appreciation or depreciation of price, the NAV of the unit trust, or through dividends that are distributed by the fund. And all of this whole process is regulated by the Securities Exchange Commission of Sri Lanka, SEC. Unit trusts are regulated by SEC. And within unit trusts, we spoke about the concept of NAV, the net asset value of the fund, where we said it is the value of all the underlying instruments inside the fund. The value of all the underlying instruments inside the fund, meaning whether you have shares or bonds or fixed deposits, repos, all of these instruments, you take the value of these instruments on a daily basis. So if it's shares, you will look at, okay, what is the closing price of the share the previous day? And then, actually, it's that day. That day's closing price is that day's NAV base. So closing price of the share, the interest rates, and therefore you value the bonds, you value the bills, you value commercial paper, asset-backed securities, all of these based on the interest rates that prevailing in the market. And then fixed deposits, you will accrue the interest. Repos, you will accrue the interest, right? Like this, you will on a daily basis look at what is the total value of all the assets inside the fund. And then from that, you will deduct that day's expenses. And this comes to, or liabilities, the expenses payable. And this will get you to the net asset value of the fund. And this is done on a daily basis, which we call marking to market. You have daily market to market. And then we spoke about the different types of funds in terms of classification of mutual funds, where we spoke about how mutual funds can be classified based on structure, investment objective, or style. We spoke about investment objective and we spoke about style. We have exchange traded funds left on structure. Okay. So when we spoke about investment style, we said you can have, depending on the mutual fund, could be passively managed or actively managed. Actively managed is where you actively try to find shares or bonds or whatever securities that are overvalued or undervalued. If it's undervalued, we want to buy and create additional returns to the fund. While if it's overvalued, we want to sell off those securities, right? Or if ideally, if we could short it, we would like to short those securities. The objective is to beat the market. Versus in a passively managed fund, what we would try to do is follow the market. So we are not trying to find securities that are overvalued, undervalued, or whatever. What we try to do is we try to figure out what are good securities to buy and hold for the long term. This is especially true if we try to mimic the market by using an index fund, by trying to mimic an index. Usually, actively managed funds charge higher fees than passively managed funds. And most unit trust funds, if you look at the style in Sri Lanka, are actively managed funds. Then we spoke about how the investment objective. Based on the investment objective, you can classify these funds as debt funds, equity funds, or hybrid funds. Debt funds including money market funds, gilt-edge funds, income funds. Equity funds including growth funds, sector funds, index funds. And then hybrid is the combination where you combine debt and equity, which is essentially where you have balanced funds. And then we spoke about structure. We spoke about structure where we spoke about open-end funds and closed-end funds. We said open-end funds are essentially all unit trust funds in Sri Lanka except for one fund currently are open-end funds, right? So we have about 70 odd or 80 odd unit trust funds in Sri Lanka. All of them, other than one fund, are open-end funds. The uh, CAL 5-year optimum fund is the closed-end fund that is available in Sri Lanka at the moment, that is listed on the Colombo Stock Exchange. And this is the typical feature of a closed-end fund to be listed on the Colombo Stock Exchange. Not the Colombo Stock Exchange, on any exchange. Because what are you trying to do in a closed-end fund? What you're saying is you open the fund up for a short period of time during the IPO, collect the money, and you give the fund manager time to manage the money. So, time to execute the strategies. Because what happens is, if you have daily creations and daily redemptions from a fund on a daily basis, sometimes it's difficult for fund managers to implement long-term strategies because investors come and there's large amounts of money coming in or large amounts of money going out. So something that they have invested for the long term, they have to liquidate in the short term. This problem is not there in closed-end funds. Closed-end funds give managers the flexibility, fund managers the flexibility to manage the fund any which way they want to, based on the objective of the fund. So there is potential. There is potential in that sense because the fund has higher flexibility, even to earn higher returns. But with closed-end funds, because the fund is closed, people are restricted from coming into the fund and going out of the fund. But you have to give an avenue for people to exit the fund, which is why most of the time closed-end funds are listed on an organized exchange. They don't have to be, but they are listed on an organized exchange. So closed-end funds are funds that have limited life. Their capital remains constant, meaning the number of units in the fund remain constant through its life. Versus in an open-end fund, the number of units keep on changing. When people come and invest money in the fund, they will go to the fund manager and invest the money, right? The money goes to the trustee. And the trustee is the one who's looking after the interest of the investors. But they will invest in the fund. And when you invest in the fund size goes up, the number of units go up because new units are created. Investing in the fund, we call it creation of units. Versus when you go out of the fund, when you want to take your money out, you call up the fund manager and say, I want to take out ₹1,000,000, right? For example. So the fund manager will then send ₹1,000,000 out to you, send cash out to you. That money will go out of the fund and the units amounting to that ₹1,000,000 will be cancelled from the fund. This process we call redemption of units. Right? So this creation redemption process means that continuously new units are being created to the fund and units are being cancelled from the fund. Therefore, the units are variable inside the fund. So is the fund size. Fund size because of the units. So in a closed-end fund also, fund size is variable, but that's purely because of market movements. But in an open-end fund size is variable, not just because of market movements, but also because of creations and redemptions. So the number of units are variable in an open-end fund. Now, when you think of an open-end fund, generally, we'll talk about other fees that are there. But if we ignore other load charges, we call them load charges, entry fees and exit fees. We'll talk about it. We'll talk about it in a minute. If we ignore that, generally open-end funds, creation of units and redemption of units happen at NAV. Right? Meaning you value all the assets inside the fund, and based on the value of all the assets inside the fund essentially, when you want to invest units, you create units at NAV, and when you want to redeem units, you create units at NAV. This is not always the case because it depends on a certain set of fees. Okay, I call them charges here, but it's very close to NAV other than charges, right? So that's the unit price. Um, you, but the point is, here the fund will trade at close to NAV or at NAV, other than if you ignore charges. In a closed-end fund, when you want to trade on the fund, there's no creation of units or redemption of units, but there is buying of units and selling of units in the open market, right? In a closed-end fund, the price is based on the demand and supply of shares in the market. Units, technically, they are not shares, demand and supply of units in the market. They are not necessarily equal to NAV. They may not represent NAV, right? So the ideal example is what I showed you. Last time we looked at the Cal fund, which is the only unit trust closed-end fund that is there in the market at the moment. So you can see here in the Cal fund, last traded price is 18 rupees. 18 rupees, right? The Cal 5-year optimum fund. This is a closed-end fund that is listed on the stock exchange. Last traded price is 18. Now, remember, I said these closed-end funds publish their NAV on a monthly basis. And right now, because we are at the end of the month, so on 2nd of April, Cal had published their net asset value. Today is 6th of April, right? So very close to NAV. There shouldn't be big fluctuations in NAV because the Cal 5-year optimum fund is essentially a fixed income fund. It is not an equity fund. The objective is to invest in multiple types of fixed income instruments. We looked at it last time. So if you look at the NAV as at end of the month, that's 31st of March, you can see here. Do you see as of 31st of March, NAV is 11.96. 11.96. However, the closing price of the share is 18 rupees. That's the last traded price of the share. 18 rupees. So that's a very big differential between, so somebody is, if they're buying this fund, buying it at 18 rupees means you're very far away from NAV. The underlying assets inside the fund are only worth 11.96. But somebody's, maybe they don't know, maybe they think that the fund will grow further. For certain reasons, there's somebody who's willing to buy at 18 rupees. For the seller, that's great. For the buyer, not so much. Because what if the fund never achieves 18 rupees, right? At the end of the period in a closed-end fund, you will distribute the money, the fund's return, right? Essentially, the fund will grow to a period. It's a 5-year fund. This Cal 5-year optimum fund is a 5-year fund. At the end of 5 years, when the fund closes down, what will happen inside the fund? All these investments, the fund manager will sell and realize the gains and distribute it to the investors. What if it never achieves this price? So you might have overpaid. You might have. You might not have, or you could have, right? But here, the spread is too high. You understand the difference between the NAV and the price is different. Sometimes it's lower, sometimes it's higher. Here it is higher, right? So what is the problem with closed-end funds? We might not be buying or selling the shares at NAV because it depends on the demand and supply of the fund, right? Of the price of the shares in the market. That's a problem with closed-end funds. But if you look at accessibility, right? Closed-end funds are thought to be more accessible than open-end funds, meaning in an open-end fund, now we have 70, 80 odd open-end funds in Sri Lanka, right? How many do you all know? Most of you wouldn't know what are the open-end funds that are available, right? You wouldn't know anything much about the funds. You wouldn't know anything much about the fund managers. You would have to find out about the fund, find out about the fund manager, call up the fund manager, and deal with the fund manager when you want to make a creation or redemption. In a closed-end fund, everything is there on the stock market. It's available for you to see. So if you just click on the unit trusts, like you will see a list of the unit trusts. So in Sri Lanka, we only have one. But just like there's a debt securities, if you click on that debt securities tab, you will see all the debt securities in Sri Lanka. Just like that, if we had multiple funds, you would be able to view all the funds in one place, right? Accessibility wise, stock market is an easier place. So that's the advantage of closed-end funds. But open-end funds trade at NAV. That is the advantage of open-end funds. So this is an issue, right? There's a question that asks, Calquant equity fund, is it a closed-end fund? It is not. It is an open-end fund. So there is no selling price in the CSC. The price is where you directly deal with the fund manager. So to correct the problems of the closed-end funds, there is a hybrid fund that has features of both open-end and closed-end, which we call exchange-traded funds. Exchange-traded funds. Exchange-traded funds try to solve the problem of closed-end funds because the argument is closed-end funds should be superior because they are traded on an exchange. It's easily accessible to people. It's a one-stop shop. Everybody is there. You can figure out what fund you want to invest in and invest, right? You don't have to open separate forms, nothing, because everything is there. You have an account with the stock exchange. And once you have an account with the stock exchange, you can buy any fund you want. Versus you go to different fund managers. For every single fund manager, you have to open up account opening forms, KYCs, all of this, just like going to multiple banks, right? So accessibility wise, closed-end funds are the better option. But trading wise, open-end funds are the better option because open-end funds trade at NAV. So exchange traded funds trying to solve this problem by offering an open-end fund with closed-end features that is trading on the share market. It is technically an open-end fund, but it has closed-end features and therefore it trades on the share market. Okay. So how does an exchange-traded fund work? Yeah. So in an ETF, what happens is you have multiple parties that are involved in this transaction, right? So you have the fund manager who is managing the fund. You have the investors. These are the retail investors. Let's call them retail investors. Right. Who's going to buy these units in the share market, right? So you have the share market. Okay. So you have the share market. Retail investors will buy or sell units of this fund from the share market, of this fund, right? I'll call this fund X. Now, X's units, investors will buy and sell from the share market. But in this ETF, the ideal, what you're trying to achieve is we call this the share price, right? This is obviously, there's nothing to call the share price. It is the share price. And then here you have the NAV of the fund. The units will trade, the share price will trade very close to NAV on a daily basis. So, how does this happen? How do you make your unit price not depend on demand and supply and trade very close to NAV? So, in this ETF, what will happen is there is another set of parties that are connected to the ETF. We call them authorized participants. Authorized participants. Okay. Authorized participants, you can see from the name, are separately authorized to deal directly with the fund manager. They will deal directly with the fund manager to buy or sell units of the fund. They will also deal buying or selling units in the market. Right? So they are part of the people that will trade in the stock exchange, including the retail investors. But retail investors cannot deal with the fund manager. Only authorized participants are allowed to deal with the fund manager. Right? So in an open-end fund, what happens? In an open-end fund, any person is allowed to deal with the fund manager. You bring money in, new units are created, you take money out, units are cancelled, right? You redeem money, units are cancelled. Any person is allowed to deal with the fund manager. In an ETF, this is not the case. In an ETF, only authorized participants are allowed to deal with the fund manager, and retail investors are not. Retail investors are only allowed to deal in the market, right? Buy or sell in the market. But this authorized participant will, by his dealings with the fund manager, create a situation by taking advantage of opportunities that arise in the market, create a situation where the market prices will nearly always reflect NAV. Let me not call it share price. Let me call it market price. Will nearly always reflect NAV. So how does this happen? One thing that you have to understand here is these funds, a lot of the time in ETFs, we call this ETFs. ETFs are more passively managed. Okay. Majority of the time, ETFs are passively managed, and you know the underlying basket. You know, for example, ETF will be, in an example, replicating the S&P SL20. So you always know what are going to be the shares inside the ETF. You always know what is going to be the proportion of those shares inside the ETF. That is a given for you. You will always know what that is. Okay. 1 second, just oops. Okay. Sorry. Okay. So famous ETFs, right? One of the first ETFs in the market was the SPIDER ETFs. SPIDER ETFs. SPIDER stands for S&P Depository Receipts. S&P Depository Receipts, which essentially mimics the S&P 500 index. Okay. Then you have the gold ETFs, right? You have the gold GLD ETF, one of the more famous ETFs, which essentially deal in gold. So it's like without buying gold to yourself, investors can invest in the ETF. ETF's underlying NAV will be the gold price. And here you're trading in the market on gold because you're not buying or selling gold, but the ETF price is reflecting the gold price. So that's what happens. Now, let me take a very quick example. Let's take gold. Let's say, for example, right now, gold prices are 2,000 rupees, $2,000, right? Okay. Gold prices are $2,000. So ideally, the market price also should be $2,000. Now, one important thing to remember here, the authorized participant and the fund manager here the exchange will not be cash for units and units for cash. Meaning, in a normal fund, right? What will happen? You bring in cash, you invest in the fund, and then you get units created, right? Invest cash. When you invest cash, you get units created. This is not what happens in an ETF. You don't invest cash in an ETF. What happens is in an ETF, you give the fund manager the underlying basket of whatever is inside this fund, right? Underlying basket of securities. So you don't give cash. Instead of cash, you buy the underlying securities. The authorized participant will buy the underlying securities and give that to the fund manager. Always you trade with the underlying security. You do not trade with cash. That's the difference. That's a big difference in ETF. So actually, to make my example easy, let's say this ETF only has John Keys inside, right? This ETF only has John Keys inside, right? So it's a John Keys ETF. There is nothing called a single share ETF. You won't see that. But just to make my example easy, right? Imagine an ETF that has John Keys inside it. It's a single share ETF, right? Not a proper example. So obviously, you understand if it only has John Keys inside it, the NAV of the fund should be equal to the John Keys share price, correct? So NAV is, let's say John Keys share price, closing price is 199, right? Like, so let's just assume John Keys right now is 200 rupees in the market. So the NAV of the ETF is 200 rupees. Ideally, market price should be 200 rupees, reflecting the NAV. Let's assume market price of the ETF is 210 rupees. Okay. Now you see, market price is higher, NAV is lower. Authorized participant sees an opportunity. What will he do? He can buy because actual John Keys in the market is also trading on the CSE, right? Actual John Keys is trading on the CSE as well. Actual John Keys is trading at 200 rupees. So what will the authorized participant do? He will buy actual John Keys from the market. And then he will sell it. He won't, sorry, let me not call it sell it. But he will give that basket of John Keys to the fund manager. So what will the fund manager do when he gives the underlying securities to him? The fund manager will issue new units. So instead of getting cash, what does the fund manager get? He gets a basket of units, a basket of underlying securities, right? So every day, the fund manager will either get a basket of securities or somebody will redeem, the authorized participant will redeem a basket of securities from the fund manager. So here what happens, the fund manager gets a basket of securities. What is a basket in this case? In my hypothetical case, John Keys, right? So the fund manager gets John Keys the share to his portfolio. The share is assigned to his portfolio. And in lieu of that share being assigned, the fund manager issues units to the authorized participant. So now on the authorized participant side, what do you see happening? Authorized participant gets units. He gives the underlying security and he gets a unit for each underlying security that he gives, right? What did it cost him? The underlying security cost him 200 rupees. He gives that to the fund manager. The fund manager issues him units. He takes that unit and he sells it in the market and he makes 210 rupees. Do you understand that? So for every John Keys share inside this fund, it represents 1 unit, right? One John Keys share represents 1 unit. That means the NAV of this fund is 200 because John Keys price is 200. But because the market depends on demand and supply, market is trading at 210, right? The market price of the ETF X is 210. Now, that means there is an anomaly, right? Market price is higher than the NAV. So this is an anomaly authorized participants are allowed to exploit. That's why they are there. That's why they have been given this license of authorized participant, right? They are there to exploit this anomaly, make profits from this anomaly. But the intention is when you're making profits, what will happen is organically, the profits will keep on diminishing. Why? Because you keep on buying John Keys in the market, right? So the authorized participant keeps on buying John Keys in the market, gives it to the fund manager. Fund manager gives him units, right? He creates units on behalf of the underlying securities received. Authorized participant takes those units, sells it in the market. Every time he sells it to all these retail investors who are buying at 210, right? Authorized participant makes 210. But what now keeps on happening? More and more units are being newly created. New units are being created and issued to the market, right? So earlier, if you had a certain number of units, now you have more units that are trading in the market. And there is more supply into the market, right? New units are being supplied to the market. And therefore, what will happen? The market price, because the supply is higher than the demand, market price will keep on falling. And ideally, it will hit 200, which is the price you need it to be. Any questions?
Madam, could you please once again explain why these authorized persons have the investment decision and fund manager does not have that? What is the rationale to segregate those decision making
Authorized
ability?
participants do not have investment decisions, right? They are exploiting profit opportunities. That's different. They see profit opportunities in the market, they exploit the profit opportunity. They see a way for them to buy cheap, sell high, they will exploit that. But they are given the right to do that because by doing that continuously, ideally the market prices should stabilize at NAV. The fund manager's investment decision is always based on an index. In this case, the index is John Keys. That's it, right? In my hypothetical example, fund manager has said, because it's always based on a transparent, predefined index. So the fund manager has, when he launched this ETF, said, we are only going to invest in John Keys. This ETF is a ETF that will replicate John Keys, for example, right? So if this ETF is a ETF that's going to replicate John Keys, you have two choices. You can buy John Keys in the market or you can buy John Keys through this ETF, right? This is a hypothetical example. In real life, what will happen is this ETF will represent S&P SL20. So in real world, you can either buy S&P SL20 shares, the 20 different shares on the S&P SL20 in the market and create a portfolio of your own, or you can one shot buy this ETF. Right? That's the advantage to the retail investors. Or if it's gold, for example, you can decide to, as an investor, you can decide to go and buy physical gold, or you can decide to invest in this ETF where the underlying is gold and replicates the gold prices. That's the investor's decision, right? But the fund manager has said, my ETF is going to be invested in gold. So he has given the parameters, gold of this quality, this caliber, and this is the number of units inside the fund, everything is transparent because he is managing it like an index. It's passively managed. Right? So authorized participants have been given the license to deal directly with the fund manager through the underlying, not in cash, through the underlying. So if the authorized participant buys the underlying and gives it to the fund manager, then the fund manager's portfolio increases, right? In a typical circumstance, what happens? Typical open-end fund that is existing in Sri Lanka, you give money to the fund manager, and because the fund manager is actively investing, managing the fund, he'll take your money, your 1 million rupees or 5,000 rupees or 100 million rupees. He'll take your money and then decide where to invest that money. Okay. But here, you don't, if you give money to the fund manager anyway has to buy gold from the market. He can't change it because he has said in a transparent manner, my portfolio will only have gold. I will have a portfolio that is only in gold. So when he gets money from you, he has to go immediately and buy gold with the portfolio. So instead of that, the authorized participant is given the ability to buy gold in the market, come to the fund manager, give the fund manager gold. So, and new units will be created. It's the same thing. Instead of cash, you give him the basket of the underlying portfolio, what the fund manager was anyway going to buy. Right? So, authorized participant, why does he have incentive to do this? Because he's trying to make a profit by looking at the trades that are going on, the difference between NAV and the market price. Authorized participant, if he sees an opportunity to exploit a profit opportunity, he will exploit that differential and he will make profits. Right? But by doing that, what is the advantage? The advantage is that hopefully in doing that continue, and these are big people, right? Authorized participants are big parties. Like abroad, it will be the JP Morgans, Morgan Stanleys, right? So big market participants. They, by doing this in bulk quantities, by providing more and more units to the market, what will happen? The market prices will stabilize at NAV. Because the authorized participant will anyway only do this until the market price comes to 200. After 200, forgetting fees, after 200, there is no incentive for him to do it, right? If the market price comes down further to 190, no incentive because he has to buy John Keys at 200. So the authorized participant also will only do it until the market price comes to NAV. After that, there is no incentive for him to do it. Does that answer your question?
Yes, madam. Then the authorized persons does not have a portfolio. Only the income of them is management fee or that kind of thing, not
No.
market gain losses.
Not management fees, right? They are making profits on buying and selling.
Capital gains, yeah.
You can't call it capital. Yes, it's capital gains, but it is an arbitrage opportunity on buying and selling. True.
Okay, I got it now. Okay, thank you.
In this case, madam, now the fund manager doesn't have to do anything active, right? So
That's
the
correct.
authorized parties are doing the work for him.
That's correct. Yes. Fund manager only has to maintain the portfolio to make sure that, so for example, gold is very simple, right? But if it's like the S&P SL20 or the S&P 500, when there changes come, there are small rebalancings they might have to do to make sure that the portfolio. So it's a very passive thing that they have to do. Then they have to deal with the authorized participants, take that security in, create units, redeem units, very small things.
Right. When there are multiple securities, he'll have to make sure that the composition remains the same, and that's it. Yeah.
That's right. Yes.
Right. Okay. Thanks.
Small question. Out of the profits that are made by authorized participants, don't the retail investors get any of that?
Retail investors do not get any of that. The retail investors' advantage is the authorized participants acting to make profits will ultimately result in ideally the market price and NAV being very close to each other. So the retail investors always get the proper price. Right? And this is the case where when you think of John keys, it might not be as relevant, but think of gold, right? The same example we can use when gold prices are somewhere around 2000. So authorized participant now, so will trade in gold, right? These are people who have the ability to trade in gold. And there'll be parameters defined that says these are the only types of gold that you can buy. It has to be this quality. You should buy this, right? So certain parameters will be defined. And now gold price is 2000. And therefore the NAV of this unit is 2000. And the market price should be 2000, but it is 2100. What will the authorized participant do? He will buy gold from the gold market, the proper type of gold, give those gold bars to the fund manager, and the fund manager will issue units, right? They'll issue units. The authorized participant will take those units and sell it in the market. When he keeps on selling more and more units in the market, what happens? More supply is created in the market. Market prices will come down and stabilize at 200. So now for retail investors, they barely see this because this should be happening very fast, right? This is not like a one-day operation. This should be happening very fast. Retail investors will see, okay, gold prices are 2000. My unit prices are 2000. So I'm getting the price of gold. When I'm trading, when I'm buying, I am buying it at gold prices in the market. But what am I buying? I'm buying paper in the Colombo Stock Exchange. Now let's say gold moves up to 2,500, right? From 2000, it moves up to 2,500 at some point in time. Ideally, then this price should also be 2,500, right? The market price should also be 2,500 for the retail investors who came in at 2,000. Now they are going to make a gain from 2,000 to 2,500. But let's say market price has only gone up to 2,400. Now what can the authorized participant do? He sees an anomaly, right? Market price is 2,400. Gold prices in the market are 2,500. What can he do?
Can sell the units to this ETF. Whatever the units he have of the ETF, he can sell it to the fund manager and get this 2,500 and put it back.
Ideally, he'll be buying units from the market, right? He'll be
Yes.
buying units at 2,400 because the units are cheaper in the market.
Sorry, yeah.
So he buys units in the market. What is he doing now? He's creating demand in the market. So creating demand in the market means market prices will move up, ideally move up to 2,500, right? But until it moves up to 2,500, the authorized participant can keep on buying. From 2,400, he keeps on buying it up until it moves, right? And whatever units he buys, he goes and he gives the units to the fund manager. So he gives the units to the fund manager, and in lieu of the units that the fund manager receives, what does the fund manager do? So the authorized participant, cancels unit. You were saying fund manager? That's correct. So the fund manager will provide gold to the authorized participant in lieu of the number of units received, whatever number of gold bars that he is due. He'll provide gold, and the authorized participant will take it and sell it in the gold market at 2,500. Right. Now, the retail investors are ensured the gold prices are 2,500. So whoever bought it at 2,000, his prices are tracking the actual gold market. Whether he bought it at 2,000 or 2,300 or 2,400, whatever, the investors, for the retail investors, their prices are tracking the gold market. That's the important thing. I don't have to go to the gold market and buy gold. If I think gold prices are going to go up, I'll buy a gold ETF. because I know I'll get the same price as the gold market, and it's very convenient for me. Right? So gold ETFs actually grow in size when gold prices are going up. This ETF, at the first run of gold when it went to 2000, when it hit the 2000 mark a couple of years ago, became one of the largest ETFs because so many investors were interested buying gold, right? So these are things that happen. But for investors, it's very interesting the fact that they don't have to go to the market, buy gold. When you buy gold, you have to insure it, you have to safeguard it. None of those things are there. You come to the exchange and you buy a gold ETF, and you know that you're going to get the same prices, gold prices fluctuating in the market. We always talk about when we do passive portfolio management or in efficient market hypothesis, we say it's better to buy an index and hold it. Better to buy an index and hold it because you don't want to beat the market, you want to follow the market, right? There's for those investors, you have to replicate an index. You have to buy, if I wanted to create the S&P SL20, I have to replicate 20, I have to buy 20 shares in the same proportion, maintain it. No, the fund manager will do all that. Authorized participant will make sure my prices equate the index movement. So now I only have to buy the index ETF as a retail investor. And I get the same returns that the index is giving me. That's the advantage of the ETF. The advantage of the ETF is the market price nearly, right? It doesn't mean always. There are always, practically speaking, it won't be exactly the same as NAV because there are fees. Fund manager charges fees for one thing, right? There are fees or commissions in the stock exchange for another thing. But all these fees are pretty low. This fund manager is also not doing a lot of work, right? He's maintaining a portfolio. So his fees are not the usual active management fees. Fund management fees are pretty low. Stock exchange also, you're being charged your brokerage and commissions, right? Technically for ETFs, again, there are concessions, most stock exchanges. Colombo Stock Exchange, we still don't have the rules out in terms of ETFs, right? But there are concessions that will be there in terms of the types of fees depending on different jurisdictions. So fees are there. Fees will make an impact to your returns, but that's a fee, right? It'll change your return a little bit. It's not going to change your return a lot. So market price and NAV are approximately equal. It will never be equal, or might never be equal, because fees will always mean that there will be a small difference. But the trend, the movement of your market price will always reflect the movement of your NAV. Is that okay? Any other questions on ETF?
And just a small question, like, isn't this the same mechanism that led to the collapse of the Bretton Woods system, like where US had to sell all their, the gold standard has to be revoked?
It's not, but I don't know enough immediately to say in terms of the differences. No. But I don't know enough to say in terms of the differences between what this is and what happened in the Bretton Woods system. Let me come back to you on that. But it is not, because whether there are similarities, let me just look it up. I have to come back to you on that.
Right. Okay, ma'am. Thanks.
Sorry, there was another question. They have to buy all the shares. Yeah. Yes. So that's correct. They have to replicate the index, but there are ways of replicating the index, right? So S&P 500, for example, 500 shares. It's not that you need to buy all 500. There are, for example, ways of constructing the index that it replicates it. So there would be concessions made by the fund manager in terms of what is acceptable and what is not. But you will still need a fair amount of those shares, and the authorized participant will have to still buy, let's say 80% or 65% or whatever of those shares to construct it in a manner that replicates enough of the index. But those the fund manager will lay out to the authorized participant what is acceptable and what is not. Okay. So, like I said, we don't have ETFs in Sri Lanka. Stock exchange currently is again looking at ETFs. We've been looking at ETFs for a while now, for a long time now. In 2012 or 13, when the S&P SL20 was launched, one of the major things that was said, 12 or 13, I can't remember, around that time when the S&P SL20 was launched, one of the main things that was said was that it will be used to create ETFs. And we are now in 2024, and we're still looking at implementing the rules and regulations, right? But it is happening more aggressively. So hopefully within another 1 or 2 years, we see something more concrete coming in terms of rules and regulations. And then you have to have parties that are interested in working in an ETF. And then you have to have retail investor knowledge to be able to trade on it. So there's a lot of things that need to fall into place for Sri Lanka to really have a proper ETF market. But ETF markets are good for investors. It's just that a lot of education is required. So you can have ETFs not just on stocks, right? Like we talked about, you can have it on gold. The most common ones are gold and commodities. Stocks and commodities. So commodities also the biggest one and the original one is gold, right? Then shares, you have the bigger ones like the S&P 500. But you have multiple share indices and multiple commodities, right? Silver, whatever that you can think of. Even things like tea, right? Are ETFs that you can have. You can have ETFs on currency, tracking a particular industry like banking sectors, tourism sector, whatever. So everything that you can do in a closed-end fund, you can do in an ETF. Only thing is most ETFs will be passively managed. To have actively managed ETFs, you understand that it is a little bit difficult because authorized participants need to know what is the underlying portfolio. So if the fund manager is changing the underlying portfolio, authorized participants need to buy a new portfolio, right? And also, bond ETFs, right? You can have ETFs on fixed income as well, on corporate debt or government bonds or whatever. So if you don't want to buy bonds directly in the market, but you still want to have exposure to interest rate movements and the way, bond prices gain when interest rates come down, you can do that through bond ETFs. So these are good ways to get investors to participate with little hassle, right? Because if you try to go to a fund manager, most investors won't choose on their own a bond ETF. But you see returns in the market, investors will buy a share, right? They think that they're buying a share. So ETFs will be like shares that are being traded in the market. And you will see that this will be a different thing that will impact the price. Therefore, in that sense, that's why closed-end funds and ETFs are good to have in the market. But unfortunately, closed-end funds don't trade at NAV. So investors who want to trade in between might not get the correct price, which is where ETFs come in. So it's a hybrid of an open-end and closed-end fund, tracking an underlying index, representing a basket of securities. So exact content of the basket is known, and on a daily basis, the fund manager daily, sometimes intraday also, the fund manager publishes the prices, the NAVs, so that depending on how often the basket changes, right? The fund manager sometimes even intraday will publish the NAV so that the market price will closely reflect the NAV of the ETF. So that's ETFs. Now, So we did the classification based on objective, style, right? So ETFs will be mostly passively managed. Most other funds are, open-end funds are, most are actively managed. So when we talk about unit trust funds, whether we talk about closed-end funds, open-end funds, or ETFs, there are fees and expenses that are involved, right? Charges and expenses that are involved. Now, everything is a fee or an expense, but just for ease of talking about it, I've classified it as two different things, right? So, what is deductible inside the fund, I have called it expenses. What is deductible outside the NAV, I have called it charges, right? It's essentially, anyway, they are fees to the investor. They are both fees to the investor. But just for us to talk about what type of fees, what is deducted inside the fund in arriving at NAV, I've called it expenses. After arriving at NAV, adjustments made to NAV, I've called it charges. Okay. So what are these fees and charges, right? For example, now NAV, how do we come up with NAV? You see, we talk about the total asset value of the fund. And from this asset value, we say we deduct the liabilities. So what are the liabilities that we can deduct? What are the liabilities we can deduct to arrive at NAV? The liabilities are all of these, right? All these expenses are deductible expenses, if applicable, as applicable, that when arriving at NAV. For example, you have to pay the fund managers, right? Fund managers will charge a fee. So that's the biggest cost of any NAV that you have. That will be the biggest cost. But see, most of the time, fund management fees, let's say, for example, for fixed income, will be in the range of 0.5 roughly. It's not a rule, but 0.5 to maybe 0.75 on the, maybe something like this, right? It will be some, so of NAV. So what fund manager will do is, on a daily basis, they will look at the asset value. Then if it's 0.75, 0.75% of your NAV divided by 365 will be charged on the asset value. Right? 0.75% divided by 365 will be charged. And that's the liability for that day. And this accrues until you pay it out. Right? So for a fixed income, generally, it will be somewhere in the range of 0.5 to 0.75. For equity, it might be in the range of 1 to 2%, right? Because equity requires more. I mean, it depends. Like for fixed income, also 0.5 to 0.75, it can be even as high as 1%. Let me put that as 1%. Depending on the type of fund. Is it a corporate? Is it an income fund? Is it a bond fund? Is it a money market fund? Money market funds will generally have lower fees, right? So the less hassle or research that the fund manager has to, in terms of, one is the type of documentation, administration, and then the type of effort that they have to spend in terms of marketing the fund, in terms of researching the underlying securities. All of this will play a part in the type of fees that they charge, right? For equity, you obviously have to do a lot more analysis, a lot more in terms of figuring out overvalued, undervalued securities. So equity fees will be higher than fixed income fees. Even in fixed income fees, bond funds, especially bond income funds, will be bond corporate debt funds, right? Like income funds will be higher fees, probably possibly, than money market funds, right? So it depends on the type of work that you have to do. Then you have a trustee for the fund. Sometimes trustee and custodian are the same. Custodian is the person who will safeguard or keep the certificates and all the securities, right? Safeguard the securities. Trustee safeguards the interest of the investors. Sometimes they're both the same. Sometimes it can differ. Trustee custodian fees are there. You have to have auditors, right, to audit the fund. These are deductible fees, legal fees, tax consultation fees. any taxes paid, if applicable, to payable, right? SEC licensing fees. If it's a closed-end fund, the listing fees, this is not applicable for open-end funds. All of these are expenses that are deductible when arriving at NAV. Once you arrive at NAV, once you know what your NAV are, you can actually, the price that you charge to create units or redeem units might be higher or lower than NAV based on other charges. What are these? We call them load charges, right? Load charges. Load charges. So load charges are, for example, what we call, you build a load either at the beginning, that means at the time of creation of the unit, or at the end, at the time of redemption of the unit. We also call them entry fees and exit fees. In simple terms, we call them entry fees and exit fees. What are entry fees and exit fees? Entry fees are when you're entering a fund and creating units, sometimes there's an upfront fee that is charged. Most of the time, entry fees are there to pay commissions to external sales force. Think of it like, I think y'all might be familiar with insurance premiums. Y'all might have heard the same type of concept in insurance premiums, right? So in insurance premiums, what do you see when you buy an insurance? Part of that insurance premium that you pay is fees payable to the agent, and the remaining is what goes inside the fund to earn returns. Same way, the NAV goes inside the fund to earn returns, but when you pay the price that you pay, part of it might be to the person who sold you the fund. Might be. Okay, there are some different reasons why fund managers have entry fees, but the majority, the biggest reason is when they want to sell the fund and they want to pay commissions to various brokers or external parties to sell the fund on their behalf, you might have a load charge or an entry fee. You had a question? So, entry fees, you can understand, you should understand, is an additional charge that you have to pay. So, entry fees are actually a plus, right? So, your price is NAV plus your entry fee or upfront load. What happens here? Let's say your NAV is 10 and your entry fee is 1 rupees, or just to make my calculations easy, let's say your NAV is 9 and your entry fee is 1 rupee. Then what is the fund's price? 10 rupees, right? But how will this work when you come to the fund and you bring in, let's say, 100,000 rupees? When you bring in 100,000 rupees, now you will be allocated units, right, based on 10 rupees. So based on 10 rupees, you'll be allocated units. So you will be allocated 10,000 units. Right? But of these 10,000 units that are allocated to you, the actual NAV of the fund is 9 rupees. The underlying assets are only worth 9 rupees, right? So if you wanted to exit the fund, and you have to exit at NAV on the same day, if you wanted to exit the fund, NAV of the fund is only 9 rupees. So the same day, how much is the value of your investment? 90,000 rupees. You actually spent money or bought in money of 100,000, but as soon as you invest, you're actually only investing 90,000. The other 10,000 is taken out as entry fees. Right? So entry fees reduce the value of your starting investment. It reduces the value of your starting investment. And then idea is that the fund will grow more than the entry fees and you will make a return well above the entry fees. That's the idea. But so that is what you mean by entry fees, right? Usually, entry fees are there only for equity funds. Usually, not always. Fixed income funds also can have entry fees, but you understand bond funds are likely to have entry fees. Money market funds will never have entry fees most of the time, right? Because in a money market fund, imagine if you have entry fees, that means you're investing a money market fund only accrues a small amount per day. So for you to go above that entry fee, there's a larger number of days that you'll have to wait. Versus in equity funds or bond funds, depending on the time you come in, if the stock market is doing well, you will anyway within a couple of days you will recover your entry fees and you'll be making returns, right? If the bond market is doing well, same way, because the prices fluctuate based on interest rates or based on market conditions. Versus in a money market fund, that doesn't happen. So entry fees usually you will see on equity funds. That's the norm. Doesn't mean that you can't see it in fixed income funds, but the norm is that you will see it in equity funds. Exit fees are what we call back-end load charges, right? Exit fees are back-end load charges or sometimes called deferred load charges. What that means is when you redeem the units also, you can implement a fee. Usually, these fees are, Usually these fees are tapering fees. They are not there forever. Unlike entry fees, anytime you enter the fund, there is a fee. No. Back-end loads taper down. Back-end loads are there to help the fund manager execute strategy. Right? You don't want a lot of people coming in, going out, coming in, going out, coming in, going out. Then the fund manager can't invest the money properly. So the fund manager needs time to invest the money and for the investments to grow. So usually what they will do is implement a back-end fee that tapers out. So a typical back-end fee would look something like 2% of NAV if you take the funds out less than 1 year, within less than 1 year. 0 if you take the funds out after 1 year. 2% of NAV if you take the funds out within 1 year. 0 if you take the funds out after 1 year. This is a typical example of a exit fee. Why? Because with that 1 year gives the fund manager time to execute strategy, time to manage the funds without having to worry about keeping a lot of liquidity to facilitate withdrawals, right? They keep the minimum liquidity required, but they can manage the fund better and give better returns. So to incentivize investors, if the investor really wants to go out, you can go out with a small penalty. But if you stay longer, no penalties. So to incentivize the investor to stay, some funds have exit fees. Again, a lot of the time, exit fees are also implemented for equity funds. Sometimes for bond funds, again, these long-term funds are there to incentivize investors to stay so that fund manager has time without investors panicking, oh no, stock market is coming down, I'm losing my investment return, so I want to get out, right? So at the wrong time, they might exit where the fund manager might think or have a view that, if you wait for another period of time, you will actually make better returns. So retailers will, in terms of most investors, they will look at the market. So the fund manager can be wrong, right? But investors sometimes can look at the market and panic in terms of short-term decisions. This is to incentivize them to stay longer. That's where you have deferred loads. So deferred load will reduce your NAV, right? In a deferred load or a back-end fee, the price will be NAV minus your exit fee. So again, if my NAV is 9 rupees, then 9 minus, let's say, exit fee of 1 rupee, my price will be 8 rupees. So what will be my price? 8 to 10. I will buy you will buy units at 10, fund manager will sell you units at 10, fund manager will redeem units for you at 8. Sell, right? They will redeem your units at 8. So now in this example that we were talking about earlier, he comes to the fund at 100,000. He brings in 100,000. He gets allocated 10,000 units. The fund's actual NAV is 9. So that means the underlying actually his 10,000 units is only worth 90,000. But let's say next day the market doesn't move and he wanted to take his money out. Because he's within this period of 1 year, he's only stayed inside the fund for 2 days. His exit fee is 8 rupees. Sorry, his exit fee and his price is 8 rupees. So his 10,000 units, he can only redeem at 8 rupees. So he'll only get back 80,000 rupees back. Versus if he stayed for over a year, depending on whatever the NAV at that time, without an exit fee, he can straight away take it at NAV. Questions?
So basically, this exit fees function as a deterrent for panic-stricken investors, something like that.
Yeah, it's not necessarily panic, but it's a deterrent for investors to leave the fund and give time for the fund manager to execute strategy. Right. Usually, it's like 6 months or 1 year type of implementation.
Thanks.
Exit fee, go back to the fund. Entry fees are for the fund manager because entry fees are to pay off, right? Like I said, to pay off external third parties in terms of them marketing the funds most of the time. Therefore, entry fees go out to the fund manager. It doesn't go back to the fund. So let's look at in our assignment also, when you go to the UTSL website, the prices, you will see the differences, right? Let's okay. So you can see here, when we go to the Unit Trust Association, the prices file. This is the week 2 prices file that is there. And see here, some funds have the same price. Some funds have different prices. Why? Different price, same price. Why? This is the buying price and the selling price. What is the buying price? What is the selling price? What is the buying price?
Price is the
Sorry, go ahead.
Selling price is the price that unit trust sells the share or unit, sorry. And the buying price is the unit that the price that the unit buys the unit. Unit trust buys the unit.
Unit trust buys the unit, yes. So unit trust buys at the buying price and sells at the selling price, meaning when you want to buy units, you buy it at the fund manager's selling price. Fund manager's selling price, right? So when you are buying units, when you come with 100,000 investment, you will buy at 176 or 20 or 25 or whatever. You will buy at the fund manager's selling price because he is creating units by selling you units at these prices. When you want to exit the fund, you will exit the fund And the fund manager will buy back your units that has been allocated to you at these prices. Now, the question is, in some of the cases, buying prices and selling prices are the same, but in some cases, they are not. Right? What are possible reasons? So where they are the same, this is because they don't have any exit fees or entry fees. They are selling at NAV, right? So you can see here, the Astro Income Fund is selling at NAV, but the Astro Alpha Fund has a difference between the two. Asset Line Income Fund sells at NAV. Asset Line Income Plus Growth Fund has a difference between the two. Consumer Staples Fund, remember, so Asset Line Income Fund is a fixed income fund. Income Plus Growth Fund is a balanced fund. Senfin Consumer Staples Fund is again an equity fund. It is a sector fund. So it is dividend fund. All of these you can see here have different prices because there are load charges. Versus Senfin Income Fund has the same price because it is selling at NAV, no load charges. By looking at these, when you have two different prices, usually it is usual. It is because you have load charges, right? And if you look at the typical type of funds that have load charges, they are equity funds and balance funds and sector funds, anything that has shares. Versus income funds and money market funds, right, don't have differences between the two prices. Income funds, money market funds, most fixed income funds don't have load charges, exit or entry. Most growth funds do have load charges. Okay. And the load charge will increase the gap between how long you have to stay to start making profits. Any questions?
Madam, regarding the assignment that we found that Calcont Equity Fund, it was in the previous price list, but it was not in the 28th price list. So what's the reason for that?
So it depends on what they have. I mean, everybody has to publish all prices, but sometimes certain prices don't get published or on that day because the person who's publishing the price is not there or something like that happens, right? So from time to time, certain prices don't get published, which is where I've said in your assignment, I've given you like some guidelines. If you don't see the prices published, see. Oh, I haven't put that in this time. I'll put it in from next week onwards. But where you don't see the prices published, you use the next working day's price or the previous working day's price based on whether it is a whether you're buying units or selling units, or essentially marking to market. So you just use the next day, the next working day or the previous working day's file. So here you can say this is the 28th file. The previous working day, you can just change this to 27 and you can get the previous working day's file. Takes a minute. So this is the 27th file. And then if you want the next working day, that was the 1st of April, right? So you can change it to the 1st of April to get the next working day's file. So in general, the rule is if you're going to buy new units, you use the next working day file. Because it's meant to be that you don't manipulate it so that you buy something at a very positive note, right? because if you use the previous working days file, you get more units allocated to you and it's better for you. So you use the next working days file if you're buying your units, meaning you're investing in the fund. But if you're marking to market or redeeming money from the fund, you use the previous working days file. But I put that note up for you all from the next one onwards.
Thank you, ma'am. Another small question regarding shares that can we when we sell share, when we take in the decision to sell shares, do we need to take the prices of shares from the of the day reporting date which you have given, or
That's
can
right.
we sell it during the week any price?
No, you have to
No.
take the reporting date.
Okay. Thank you.
So these are some
excuse me,
Go
ma'am.
ahead.
Just for clarification, so let's say if a share is doing well on the 26th, is it possible to use the 26th CSC daily report and buy a share on that day, or how does that work?
No, you because your hypothetical week is all Fridays, right? And if Friday is a holiday, the previous day, but the previous working day. So always it's that end of week closing price that you use.
Oh, so we can't use any of the middle day prices, is it?
You can't. That's why the reporting date is there. You have to use the reporting date.
Right. Right. Okay. Thank you. Thank you.
Yeah. So these are some small examples of different funds, right? So 3 different funds, actual funds that are there in the market, in our market. You can see here for fixed income funds, how the fees are, right? Fund A, B, C, you have management fees 0.65, 0.5, trustee fees. Some funds have custodian fees separately, right? In equity, management fees are higher, right? This fund has a lower management fee, but they also have a performance fee, right? So if you overperform the index over a certain percentage, if you overperform the index, they make a certain percentage over and above the overperformance. So in this fund, then you have trustee fees, custody fees. You see here that a lot of these funds have front-end fees, a lot of equity funds, but this does not. This fund doesn't have front-end fees, right? But most equity funds have front-end fees. Most equity funds have deferred load charges as well, back-end fees as well, but some don't. Fixed income funds, most don't have front-end fees nor back-end fees. So you can see, right, even in exit fees, it tapers out. It's 1% if less than 1 year. After that, no exit fees. Here you can see first year, second year, third year, 3 to 1%. And then from the 4th year onwards, no fees. It tapers. So exit fees usually taper out, but front-end fees are constant. Shall we try an example? Let's quickly try an example. This is your 2021 paper. Question number 9. So part A is calculated NAV.
පාසානි දඹරාහන්
Game of Thrones y'all are on So just take each line by line, look at what is the asset value, take out the liabilities to come up with the net asset value and then the net asset value per share. Line by line, have your numbers, right? Because otherwise I won't be able to tell if you're right or wrong. Just think of ADR also as a share. Right? Don't worry about the terminology. You come across ADRs later when you do the share section. Just think of it as another share. You have to find the NAV as at 31st December. It actually takes more time to read the question than to do the question, okay? Calculations wise, there's not a lot that you have to do. You all have questions? Tell me. And remember to pick and choose what's important to the sum, right? Every single word here is not important to the sum.
Small question, ma'am. Like for the U.S. government securities, the convention we are supposed to use is 360, but for repos it will be 365. Is it?
You can assume 365, that's okay. So roughly it's about a 20-minute question, both parts and A and B together. Five more minutes. Not giving any answers here. Okay, I have one answer. I'm waiting for confirmation from somebody else. So in the meantime, you can try part B. Anybody else? Answers? So now you're like close to 25 minutes and you're still in part A, right? Maybe 20 minutes. Okay. So I'll do it here in the interest of time. Otherwise, waiting for you all to give me answers, it might take a lot longer. So look at, like, a lot of things are not necessarily required, right? So you have to take from these questions, you have to take what is required for the question, because it might be that the rest of it is required for the next part of the question. Okay, between right. So the para is not relevant for us. Calculate the net asset value as at 31st December 2020. Now, what are we doing? We have to calculate the total asset value of the fund, deduct the expenses or liabilities to come up with the net asset value, right? So first, what do we need to do? We have to calculate the total asset value of the fund. So what do you have in terms of assets? What do you have in terms of assets? You have shares of GameStop, right? 908,675 at 18.84 per share. At 18.84 per share. Which means as of 31st December 2020, you have GameStop value is 17 million, right? 908,000 shares of GameStop. And an 8.05 million in Abcam ADR, and I told you to think of it like shares, right? So the ADR has 8.05 million. So because these are all in purchase date, 17.12 million shares of GameStop, 8.05 million of ADRs, and other shares, 168.232. Right? So all the shares inside the fund is 193.4, correct? That's all the shares inside the fund. The asset value of all the shares. Okay. Then, if there's anything wrong, tell me, right? Then the fixed income. So when we look at the fixed income, it says.
Madam, don't we add this preference values to this?
Oh, I missed it. Sorry. Thank you. So there are preference shares of 3.536. Okay. So actually, it's 196.94. That's the value of all the shares. That's the asset value of all the shares. Right. Then short-term investments made by the fund. Here you have Morgan Stanley Liquidity Fund. Right? So they've invested in another unit trust fund. This is like your assignment. You see, this is part from your assignment. This is coming from your assignment, right? They've invested in another unit trust fund. So you have the liquidity fund where they have invested 44.1 million units at $1 per unit, right? That's 44.10 million there. And then repo agreements with Barclays, HSBC, and Merrill Lynch. Both Barclays and Merrill Lynch total 0.42, right? Barclays and Merrill Lynch total 0.42 on 31st December 2020. So that was the day the investment was made. So there's a repo of 0.42 there, right? The rate is not relevant for us right now because we are still on 31st December 2020 and the investment was made on 31st December 2020. And then a 1.167 million repo investment with HSBC carried out, 1.167 million investment with HSBC. Carried out on, at a rate of 0.05%, maturing 4th of January 2021, on 29th of December 2020, and we are on 31st of December. So how many days do we have this repo? At the moment, we have accrued interest for how many days?
3 days, right?
2 days, no? 29 to 31st. So 1.17 into 1 plus at 0.05, 2 days over 365. Okay. So, yeah.
Just to clarify, ma'am, now if we have placed the deposit on 29, shouldn't we get the interest for 29th, 30th plus as at the 31st of December? The interest will be accrued for that date also, right? As the end of the 31st. It is not, is it?
So you either accrue the total interest on the 29th or the 31st, right? It's like the bond. One day you don't get, right? The last day. So technically you get the first day of interest, but you don't get the last day of interest. But it's enough to assume on the last day of interest.
Right. Okay. Thanks.
So here it says the repo was secured against a government bond maturing 31st of October. This is not required for this part of the sum, right? Because this is about the security of the repo. Security of the repo, remember we did about like how much collateral. This is about the collateral. We are not concerned about the collateral. We are concerned about the repo and how much it is worth inside the unit trust fund today, as at 31st of December 2020. Right. So this is all there is in terms of short-term investments. So short-term investments total is 45. Then what else does it say? Outstanding liability. So now we can find the total asset value, right? Because now they're talking about outstanding liability. So now I can find the total asset value, which is what? This total fixed income plus total shares, 242. That's my total asset value. And then it says liabilities of the fund, total 13.05. It's talking about expense ratio, but it's not necessary, right? Liabilities total 13.05. What do you mean by the expense ratio? What do you mean by the expense ratio? Oh, that's not difficult. Expense ratio
Expense incurred per each unit.
Yes, it is the expense incurred per each unit. It is when you take into account your management fees, trustee fees, custodian, audit fees, legal, all of these together, what is the expense, total expenses of the fund? So generally the expense ratio is, we calculate it as all the expenses over 1 year period divided by the average NAV of the fund. All the expenses over a 1 year period divided by the average NAV of the fund, right? So The expense ratio calculates essentially what is the average expense rate of the fund. So you deduct the liabilities of 13.05 to come up with the NAV. $13.05. And then it says load charges. Load charges are after we find NAV. So we don't care about load charges right now. Front end load and back end load, they're there. But that's not, remember, to arrive at NAV, the only thing that's relevant is expenses. Load charges are after you calculate NAV, right? And here the question is, what is NAV? So then you have to find net asset value of the fund. NAV per unit is what we're trying to find. So what is the net asset value of the fund? 229.5744. Right. So that's Prasad, you're correct. And then you look at the number of units. The number of units is 12.29. Right. So 229 divided by 12.29. That is your answer. Generally, to 4 decimal places, 18.679. That's the NAV of the fund. Any questions here? You see, it's very simple in terms of the calculations. This was the only thing, others were additions, right? This and this was the only big thing that you had to do. That's not big also, right? And the others were additions and deductions, right? So reading the sum takes a lot more time than the actual calculations. Understanding what is relevant and what is not relevant is what takes time more than the actual calculations. So part B, can you quickly do part B? 2 minutes. How many units does the investor receive when he invests $5,000? That's very easy. How much is it? 267,668. Let's see. So on 31st December, at what price does he get created units when he comes on 31st of December 2020? Does he get created units at does he get created units at 18.6798? Yeah, does he get created units at 18.6798? Just give me 1 second. Sorry about that. Sorry. So I was asking, does he get do units get created for him at when you bring in 5,000 rupees, when you invest 5,000 rupees, do you get units created at 18.6798? That's my question. Yes or no? Yes, there is a front end load here, right? You have fund charges, front end load of 5.25 and a back end load of 2%. 2% as long as the units are redeemed within 1 year of investing. So there is an entry fee of 5.25%, right? So what's your price? This is your creation price. You have to add your entry fee to your unit trust, NAV, right? To your NAV. That's your creation price. So based on this creation price, 19.6604, right? We usually use 4 decimal places. Right? So 19.6605. How many units get allocated? He brings 5,000 rupees. 5,000 divided by 19.6605, 254.317. Right? So 254.317 units get allocated to him. Again, usually use 4 decimal places. So 254.3170 units. This is the number of units he gets on 31st December 2020. Now, if the fund's NAV on 31st December 2022, 31st January 2022, fund's NAV is 10.32. Okay. What is his investment worth on 31st January? What is his investment worth on 31st January? Yeah. Do you have to take into account exit fees?
No, just to multiply the NAV by the allocated number of units.
That's correct. You don't have to take into account exit fees because it's 2 years. Exit fees are there for 1 year. So it says here, if redemption is 2%, if units are redeemed within 1 year, but He came on 31st of December 2020. He is now going out on 31st of January 2022. That is over 1 year. So he can redeem at NAV. NAV is 10.32. So how much is his investment worth? 10.32 into 254.317 units. His investment is worth 2.674 million US dollars. Okay. Oh, sorry, not million. 205,000 rupees only. Investment is worth 2,624 US dollars. So you can see here from 18 rupees, NAV has come down to 10 rupees. From 18 rupees, NAV has come down to 10 rupees, which is why his NAV, why his investment has come down. He invested 5,000 rupees, right? He invested 5,000 rupees, but his 5,000 rupees after 2 years or after 1 year, after 1 year and 1 month is worth 2,600 rupees, 50% decline in his investment, partly because probably the share prices have come down and it's mainly with the share prices, right? The asset value has come down. Also, a dividend has been paid. A dividend has been paid over the period. How much is the dividend? 0.0297, 0.0297 rupee dividend. So he had 254,000 units, 254 units. So he got a $7 dividend. He got a $7 dividend. So in total, his returns were 2,632. So returns you have to show as a percentage. What is his non-annualized holding period return? Remember, what is return? Your return is equals to your capital gain plus dividends as a percentage of your initial investment, right? So what is your capital gain? The capital gain is...
It's a capital loss in this.
In this case, it is a capital loss. 2,624.55 minus 5,000, right? That's your capital loss. Plus you have dividends of 7.55 divided by your initial investment of 5,000. You invested $5,000, right? So how much is that? Negative 47%. Any questions here? Okay.
Can you do it again, madam? How to get negative 47?
So it's your capital gain. What is your capital gain? On 31st December, you invested 5,000, right?
Okay.
You invested 5,000. That is your P1.
Yeah.
Right. This is your P1. Then at the end of 31st of January, how much money do you have? That is
200.
P2.
P2.
Yeah, 2,624, right? So what is your capital gain? 2,624 minus
Okay.
5,000. Plus dividends. 7.55. That's negative, no? So
Yeah.
that divided by your investment, you get 47%.
Okay, thank you, madam.
Other questions? Okay. Right. So let's take a break. It's 10:20, 10:40.